The alarm reads 5:23 a.m. You silence it before the second pulse. You've been awake since 4:47. The coffee is already cold. You haven't touched it. You are 22 years old. Your student debt is $87,000. Your signing bonus sounded enormous until you saw the MD's bonus slip left open on the printer by accident. 3 seconds. That was enough. You are an analyst. That word means nothing yet. It will. Right now, it means you run models at midnight. Format decks nobody reads until 6 a.m. Find errors buried inside spreadsheets attached to deals worth $400 million and fix them quietly and say nothing to anyone. Because saying something costs more than it earns at this level. The system teaches you this without speaking. You learn it inside the first month. You don't complain. You don't slow down. You watch the geometry of every room you enter. Which managing directors command silence when they speak? Which ones get interrupted? You are not in those rooms yet, but you are building the map. One late night at a time. Your days are 16 hours, sometimes 19. You stop counting after month 2. You learn to read a 10K in 45 minutes flat. You learn which questions to ask in a team meeting and which ones to hold. Your year 1 bonus is $28,000. You wire half home. You feel nothing specific about what remains. Just forward motion. That's all this phase is. 2 years in. Associate. The title changes. The hours don't. But something else shifts. You are in the room now, not the main room. The side room where associates sit and wait. Still, you're there. You sit across from a CFO for the first time. Your voice doesn't shake. You've run this exact scenario 60 times in the past week. That is the only reason your voice doesn't shake. Preparation is the currency at this level. Nothing else purchases credibility this early. The deal is a leveraged buyout. Regional distribution company. Midwest. The EBITDA margins are clean. The debt service coverage holds. You build the model, you present it, the deal closes. 3 months later, the company cuts 200 positions across 2 facilities. You didn't model that. Nobody asked you to. You model margins and debt ratios. You collect your bonus. You don't think about Ohio. You rationalize it the way everyone does at this level. You just ran the numbers. The second rule, proximity to capital is proximity to decisions you'd rather not own. You start building a network, not friendships, alliances. A VP who routes deal flow your way. A director who gives you advance notice on mandates before they're circulated. You protect each other, not out of loyalty, out of mutual utility. That distinction matters. It doesn't feel like it yet. It will. VP level. You manage people now, 4 analysts, 2 associates. Their errors are yours. Their late nights become invisible to you because your attention is somewhere above them entirely. You think in deal flow now, not hours, not tasks. Deal flow. You close your first transaction independently. A $580 million acquisition financing. European infrastructure. Your MD is on the cover sheet. You are on page 7. But in the room, the client is looking at you when the numbers get complicated. Not at him. At you. That is the shift. You are no longer supported. You are a producer. The ethical architecture becomes clearer here. A target company's pension obligations restructured post-close. The acquiring fund needs a 19% FI ARR. The restructuring makes it possible. You understand what it means for the retirees. You don't say it out loud. Nobody says it in the meeting. The deal closes in 9 weeks. Your year-end number is $390,000. You wire $30,000 home. You buy a 2-bedroom in a city where a 2-bedroom means arrival. You tell yourself the pension was already compromised before your model touched it. You might be right. That ambiguity is where you live now. The third rule, at VP level, you stop asking if the deal is good. You ask if the deal is executable. At this level, that is the only question that survives the room. Director, you're sourcing now, not just executing. Originating. Private equity firms route deal flow directly to you, not your MD, you. 3 closings in 3 years, 0 missed deadlines, 0 information leaks. That's worth more than intelligence at this level. You manage $900 million in advisory mandates. You sell confidence now. That is the product, not the model, not the deck. Confidence. You start to understand informational leverage in its purest form. You know which companies are running a strategic review before it's announced publicly. You know which sovereign fund is quietly accumulating a position before any disclosure hits. You don't trade on it. That's not what this level is about. But you know. And the knowing changes how your instincts operate. Permanently, you lose one, a $2.4 billion mandate. Not because of your numbers, because a competing director played golf with the chairman at a private club you didn't belong to. A membership. That is the entire reason. You don't lose your composure. You don't make excuses to anyone. You join 2 clubs inside 6 weeks. At director level, the deal was never just about the numbers. It never was. Managing director. The calls come earlier now. Sometimes before markets open, sometimes from numbers that aren't stored anywhere on your phone. You manage 14 client relationships, each one worth between $4 million and $35 million in annual fees. You are no longer working for the bank. You are the bank's relationship with these clients. That distinction is quiet when it arrives. It is also total. You sit on an internal credit committee, $850 million in revolving credit. The balance sheet is visibly deteriorating. You vote yes anyway. Not because the credit is clean, because losing the relationship would cost 3 times the exposure. A political decision dressed in the language of credit analysis. Most major decisions at this level are exactly that. You travel constantly. Zurich, Abu Dhabi, Singapore, Seoul. You have dinners with ministers, not politicians. Ministers. These are not business dinners. The relationship is the business. Capital doesn't follow returns alone. It follows alignment, regulatory familiarity, trust between the right people in the right rooms. Your identity has quietly restructured itself around the machine. You don't notice when it happens. Nobody tells you. Nobody does. Partner. Your name is attached to the fund now. Carried interest in every major deal the firm runs. You stop optimizing for the annual bonus entirely. You think in 5-year fund cycles. You think in decades. You led a $3.9 billion acquisition of a European energy infrastructure company. 4 regulatory jurisdictions. 3 months of negotiation. 2 competing bids. You ran the consortium. Your fund, a Gulf sovereign co-investor, a Canadian pension. You structured the offshore holding through Luxembourg into a Cayman feeder fund. The tax efficiency is substantial, entirely legal. 2 attorneys in Dublin and Singapore blessed every angle. You sign without hesitation. Your carried interest on this single transaction will compound past $35 million. Your social world has narrowed to people who control capital. You stop attending events where the conversations aren't productive. It happens gradually, then completely. 2 calls today. 1 from a Gulf sovereign wealth fund, $6 billion seeking deployment. They want your fund to anchor the deal flow. You are one of 3 firms receiving that conversation. The second call is from a finance ministry, not a banker. The minister. You take both calls from the same room. 41st floor, corner office, no trading screens, no terminal. Just glass and silence and a phone that connects you to people who move entire asset classes when they decide to. You are not in the market anymore. The market is in you. Your positioning, your deployment decisions, your sentiment move price discovery in the sectors you touch. When you pull back, analysts write about it for weeks. You sit on 4 corporate boards. You brief 2 governments annually on capital market conditions. You don't lobby, you advise. The distinction is technically real. The influence is functionally identical. The moral architecture becomes abstract at this level. Consequences are too distributed, too diffuse across too many institutions to locate in any single decision. You don't feel the layoffs downstream. You feel the fund return. You optimize the fund return. That is the system. The 7th rule. There is no outside perspective anymore. You are the perspective. No title, just a name, a trust. The trust owns a holding company. The holding company holds positions in 11 financial institutions across 7 jurisdictions. You are 68 years old, 44 years inside the machine, total assets above $70 billion. The exact number is known to 5 people. You are one of them. 3 central bank governors know you by your first name, not by any title, because the information moves in both directions between you. You don't trade your position anymore. Trading responds to the market. Positioning precedes it. A year before anyone in the press understands what is forming, you see a currency corridor approaching liquidity stress. You structure accordingly, not to trigger the event, to be correctly positioned when it arrives. When it does, the funds gain. The press calls it prescient risk management. The cost of this level is not something anyone prepares you for. The people you fully trust number fewer than 8. Beyond that circle, nothing. You have more access than anyone remaining in your life can understand, and you have almost no one left to tell. Somewhere below, in a glass tower in a city that never stops moving, a 22-year-old opens a terminal for the very first time. His badge says Analyst, first year. He thinks this is about salary. He thinks the system rewards what you put into it. He doesn't know yet what the system actually rewards, but he will find out. The terminal blinks. The market opens. The machine takes another step forward.